Hi, I'm Jeff Greenspan, Managing Director of Financial Modeling Services. You can reach us using the information on this screen. Today we're going to talk about the basics of investing. Many people consider investing to be confusing, but it doesn't have to be. The most important thing to know about investing is that time is your best friend and worst enemy. So don't wait, let's get started. Here's an overview of everything you need to know to invest with some degree of competence. We'll start, of course, with a few definitions. Investing is the process of setting money aside for the future. Obviously, you'd like that money to be worth more in the future than it is today. An asset is anything that has value. From an investing perspective, assets should generate some sort of positive return over the time period of the investment, meaning they're worth more later than they are today. Your personal home is generally not considered an investment asset because you have to pay money out every month in order to live in it. Although in some cases, it may end up being the thing of greatest value to you. An asset class is a set of assets that are similar. For example, stocks, bonds, real estate, and cryptocurrencies are all assets. Note that most assets can be subdivided. For example, stocks can be broken into large cap stocks versus small cap stocks, or international stocks versus domestic stocks. And now we come to the important definition of risk. All investing contains an element of risk. No one can predict the future, and past returns are no guarantee of future results. There are two types of risks that we typically identify. Systematic risks affect all assets. They're created by general economic conditions, or pandemics, or that sort of thing. Specific risks affect only one company. They might be based on operational factors, like a company deciding to roll out a new product. Perhaps Apple is going to roll out an iCar, or financial factors, like how much debt a company has. Investors can reduce their specific risk through diversification. Combining different assets or different asset classes improves diversification and therefore reduces specific risks. And risk is defined by volatility, how much an investment's value swings around its average price over time. Investments whose prices go up and down frequently and by a large percentage have high volatility. Because every investment has risk, and because the market price of a stock already incorporates the perceived risk of that investment, investing in only one stock is almost the same as gambling. You really have no idea what direction that investment will go. The rest of this video will focus on the stock market, though a prudent investor will also want to own real estate, businesses, or alternative assets. You have to get started somewhere, and it is easy and reasonable to get started in the stock market. The quickest, easiest way to invest in the stock market is to invest in one or more exchange-traded funds. These index funds attempt to replicate an entire asset class or subclass. This chart lays out the 5 primary asset classes, suggests one or more representative index funds, and displays the returns and volatility for each fund for the period from October 17th, 2019 to October 16th, 2020. Note that higher annual returns are almost always associated with higher volatility, that is, higher risk. Your job is to pick funds based on your tolerance for risk. Note, however, that high risk isn't always bad depending on your time frame. If you're investing for the long term, higher risk investments should provide higher returns. Academic studies point to 2 methods of investing that generally result in higher returns over time. Dollar cost averaging is a method whereby you invest approximately the same amount every month. This is a very common method typically associated with automated payroll deductions. Since many companies match a certain percentage of your investment, you'd be crazy not to participate. I suggest you pay yourself first and allocate 10% of your salary towards retirement investing. Value averaging is typically used to invest for a specific event. If your goal, for example, is to have $60,000 in the bank after 60 months, you know that your portfolio needs to be worth at least N times $1,000 after the nth month. So you invest the appropriate amount each month to meet your monthly target. There are several types of accounts into which you can put your investments. A tax-deferred account is designed for retirement savings. These accounts grow tax-free. There's also a type of account called a Roth account, which not only grows tax-free, it allows withdrawals to be tax-free as well. Roth accounts are the best thing since sliced bread, and everyone should make every effort to maximize their Roth account every year. IRAs and 401ks also grow tax-free, but earnings are taxed at your ordinary income rate when you withdraw money upon retirement. Taxable accounts are typically used if you need the money before retirement. In this case, you open a normal brokerage account. Fees matter, so lower cost brokerage accounts are better than higher cost accounts. It's important that you don't try to time the market. This slide indicates some of the different asset classes that you might invest in and shows which asset class has done the best in a particular year. You can see that every asset class at some point has done the best in that particular year and also the worst in that particular year, except for one, the one in purple, and that's a diversified portfolio. The entire benefit of a diversified portfolio is to keep you from losing a ton of money when the market heads south. Of course, it can also keep you from making a ton of money if certain segments of the market head north, but it's really a guessing game as to which segment will do the best. You're better off investing in a relatively diversified portfolio and doing it over the long term in order to guarantee wealth accumulation. Last but not least, we have to have a disclaimer. Our company, Financial Modeling Service, does not provide advisory services at this time. We will not ever tell you what stock to buy or what fund to buy. We can only help you understand what the consequences of your particular strategies might be by using financial modeling. Last but not least, here's how to reach us. If you like, please subscribe to our YouTube channel and feel free to reach out to us. We look forward to hearing from you.